Hello and welcome to Pro Trader Strategies Market Commentary for Monday, September the 19th. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these daily market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies you can implement into your own portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, let's get this on. Not a whole lot of economic data today, as Mondays are generally the case, but we did get NAHB, which is the National Association of Home Builders Index, and it came in at 65, which is better than the expected 60. One thing to note was they did revise last month's down a little bit to 59. That being said, the overall markets, a little bit of a mixed bag overall. We've got crude oil just a little bit higher by 50 cents and pushing up against this key Fibonacci 50% retracement level. So that is following true with what I had talked about, that being a support resistant line in the sand. The real value area is just slightly higher, and today we broke above that fib level but have since been bouncing up against it and failing to get above that. So the bulls are trying to get above that line, the bears are defending it, and the bears seem to be winning in that battle right now. Onto gold /GC up just over $7, but the key thing to note here is it is below that 50-day moving average, which would indicate that it's going to act as resistance on the any type of bull rally. The other thing to note is the 9-day moving average did break below the 50-day moving average, which kind of starts to indicate a little bit ahead of time that there could be moving into a bear trend. I talked about this though. The real line to break below is right here, anywhere below 1305 to 1306-ish area. If the bulls can get it to set, or the bears get it to settle below that level, it's going to look like more of a bear trend. The psychological level is going to be that 1300 level that most people are probably going to be looking at trying to defend. But the reason why I say below that 1305 area, that's going to make it where we've had lower highs and lower lows, which is generally the main consensus on turning into a bear trend. As soon as you have lower highs and lower lows, that is consistent with a bear trend in technical analysis. On the bonds right here at the point of control, right up against the 200-day moving average. That's been acting as support and resistance. Once we get below it, it's going to act as resistance on the way up. But it just happens to coincide with the point of control, which is where the most volume and time has been spent for the bonds over the last year. And that is important to note because heading into this week, we have the FOMC meeting. And it's a 2-day meeting, and it's going to be where Janet Yellen is going to come out with their rate decision, whether or not they're going to raise interest rates. I've been in the camp where I don't think that they're going to. I don't see any economic data out there that really supports needing an interest rate increase, but they may still do it nonetheless. But the bonds, in that meantime, I think are going to be very comfortable right here at this level for the next few days. So keep that in mind. As you can see, bonds basically unchanged, up only one tick on the day, but a very tight range as well. Then on the NASDAQ has been leading the way to the upside, and it was the lagger on the downside when we had the sell-off in the last couple of weeks when we started moving down early on, late in the week and early on. That really was counterintuitive to the rest of the overall equities. Today it is leading the way to the downside. As you can see, down 13 ticks on the day, very close to the lows of the day. But Apple being a big part of that, Apple was the one that was really pushing higher as the overall equities were selling off, and that was what was the catalyst to keeping the NASDAQ up, because it is such a high component within that index. And on to the E-mini S&Ps, they're up 3.5 points on the day. This is where I was talking about that mixed bag. We've got the NASDAQ down, we've got the E-mini S&Ps up on the day. Another thing to note here is we also have this looking like an indication of moving into somewhat of a bear trend here. Now, how long that happens, I don't know, but we do see this with the 50-day moving average and the 9-day moving average crossing below it. So that's starting to indicate more of a bearish move. So we'll be looking towards that. If the Fed raises interest rates, we could easily see these equities throw a bit of a tantrum and go to the downside. So that people are going to be waiting for that. Then this is the 15-minute chart of the E-mini S&Ps /ES down, up 4 points on the day. But as you can see, we just made new lows in this last 15 minutes or so. So the overall market has just created intraday lows. On to a few trades. These were trades that I ended up taking off on Friday, and the rest of them are some ones that I let expire Friday. So Halliburton is up on the day, but I had on the September 43 puts, and I originally paid $1.86 for those. I got out of those for $2.12. So that one I covered on Friday just to make sure that I got out of those for a bit of a profit. Plus, they were in the money, and I didn't want to have that stock. And then with Visa, ticker symbol V, I had on the September 83 puts that I was long and short the 78.5 puts, and originally paid $1.87 for those, and then I got out of them for 83 cents on Friday. Then GM, I had another day on these calls that I was long. I had on the September 32 calls that I originally paid 57 cents for it, and like I said, those were out of the money, expiring worthless. But today, lo and behold, we got a spike. So if I had just one more day in those, or maybe even rolled those out, I would have been able to run those into the money. But one thing is a rule of mine: anytime you're paying a debit for a spread, there's no sense in trying to roll that out and throwing good money at bad money. So that is a rule, a strong, hard rule that I have. So I did not move or do anything with those. Then with Netflix, I also had on some September 90 puts that I was long. Obviously, those never came into fruition. I thought we'd get a little bit of a pullback, and that just never happened. And then with SPY, I talked about these, that I would love to see these expire worthless, and I be careful what you wish for. I got that. These were actually a profitable trade at one point in time, but it was such a small portion of my overall portfolio. I did it to add some long deltas in there, and when I was getting really short deltas, the overall market kept continuing to go higher. And when I put this trade on, I said I would love to see these expire worthless. They did, but I had on the September 217 calls, and I originally paid $3.71 for those. So that pullback, I got what I wished for, and those expired worthless. They were in the money at one point in time, but it was such a small part. I needed to have those long deltas just to give me a little bit of upside hedge. My overall portfolio is generally negative deltas, and it's gotten more negative now that a lot of these have come off. These September contracts have come off the board. So that being what it is, I'm also trying to get a couple other trades going today. I have on I'm working Win. I started chasing this as soon as it broke below Friday's low on a bearish trend. It just looks like this is a topping pattern. This is a confirmation of that. And again, another thing is if it settles below this value area high, that is even more of a bearish type of setup, if you will. So I'm trying to do a synthetic short, which is the webinar I did on Friday. And if you want to find out the rules of that, go to protraderstrategies.com and sign up for that. It's a great strategy, especially for overbought markets, something like WIN on a day like today where it looks like a good shorting opportunity. This is going to act like as if you borrowed the stock and were short this underlying. So, but one of the nice thing is we don't have to pay the dividends. When you're short stock, you have to pay those dividends. You also don't have to borrow the stock. The other thing is you don't have to wait for an uptick, and ultimately you're using about half of the margin that you would have to come up with if you were just to short that stock. And then that leads me to that increases your return on capital. So if you're using less capital but you're getting the same type of risk reward, then that increases your return on capital. So your ROC is much higher with this type of strategy using these options. All right, that's all I got for you guys, other than Friday's webinar is going to be on how to protect your portfolio in a rising interest rate market, which is huge because most people have allocated 25 to 75% of their portfolio to bonds, and when interest rates rise, that is going to really hurt that portfolio value. If you have $250,000 in bonds, interest rates go up by 1%, that bond portfolio will decrease in value by $50,000. So that is a huge decrease in value by just 1%, and we're increasing at quarter percent. So you can imagine what a quarter point increase could hurt your portfolio by $10,000 or more just on a small adjustment. And it has been known in the past when inflation starts really getting ramped up that they will increase at a percentage point at a time. So we have to be diligent and get in there and really start defending the value of our bonds. So check that out, protraderstrategies.com. Sign up for that. The more the merrier. And if you can't take that, take it easy.